Okay, everyone, welcome. We're just going to get started here with the webinar. First things first, before we get started, make sure you read the disclaimer. Uh, JTrader and I don't really want to be sued by you or chased down if you make a decision based off of what we're going to tell you. Likely not to happen, but make sure you read this and understand it and know that JTrader and I and anyone affiliated with us is not responsible for any of your decisions in the market. Okay, great. So welcome to large caps, options, and volume profile. JTrader and I decided to get together and we're trading together on a daily basis along with some other awesome traders just in a little side room that we have for us. And there's a lot of really great info and a lot of our trading styles um, um, fit together, and we thought it'd be a good idea to start sharing some of what we do with you guys. JTrader runs his room, JTrader Small Cap Room, on Discord, and you can find that on his Twitter at twitter.com/jtraderco, and you'll find details on how to join his room there. And then you can find me on Twitter at Del the Trader. And you might know me from Bear vs. Pig, where JTrader and I initially met and became friends. And there's more details to come on that later. And then also need to highlight activetraders.chat. This is um, my trading room. So we'll have more details on that later on, but this is the webinar and we're just about to get started. So maybe I'll let JTrader say a few words as well.
Um, Good evening, everybody, or good afternoon, depends where you are. I let Dell talk. He's a better speaker than I am. I want to just say two things here, and then go right away into the game, the setups, live market trading. So first of all, I want to thank Dell for putting up all this, and I wanted to have a webinar with Dell because I consider her a trader. Be very frank, a lot of garbage out there, and he's one trader that he has 8-9 years of experience, which for me are considered the minimum that you have to have a chat room to help the others to know what you're talking about. So if you're one of those traders that you want to learn something, really learn something, and not following live trading signals, but really to invest your money and to know what you're doing with your money, to control them, okay? Because that is to have knowledge. Then I suggest you really like to look very good into Dell, the trading material. I trade every day with them. When 3 or 4 other guys in a private room, we just like share ideas, and these guys are tough. They're not like the guys that enter a trade with 10K shares, but that's can be a feeler. So I can see different style of trading, and I see my style pretty different to Dell. We have the same goal at the end of the day. We look at the same things, but with different approaches. So what we're going to talk about will be very, very interesting. Okay, Dell.
Yeah, fantastic. Thanks a lot for that. I really do appreciate that.
I say always the truth, bro. I say always the truth. Being we are in our little room, or being that we are here.
You tell it how it is, man. It's always been. Um, Yeah, you guys are going to find out right now how different our styles are. They're very different. And so JTrader is going to be talking about large cap stocks, options trading, and most importantly, from small account perspective, because that's really what's important. And then I'm going to be walking through after JTrader. I'm going to be walking through volume profiles, some structure analysis, and doing a top-down proper technical analysis of the market. And I'm going to try and dispel some of the misconceptions about technical analysis and try to unlearn you some of the things that you may have learned in the past that I found to be total horse poop. So anyway, I'll let JTrader uh, take it, and we're going to start by screen sharing, and we're going to start going through um, all of the stuff that I just mentioned, and then also just before I start, just make sure that you guys are aware. At the bottom of the screen, if you just joined us, at the bottom of the screen you'll see a little Q&A icon, and that Q&A icon will allow you to ask questions. The questions will be upvoted. So as you can see here, I'm just showing you some of the questions that are already starting to come in. If you like the question that you see in the Q&A, just click the thumbs up and it'll go up. And at the end of the webinar, we'll have a little Q&A session where we answer from top down the most popular questions. Okay, all right, let's get started.
Okay, guys, so I tend to be very fast in what I say and very direct. So first, thanks again to be here. What I want to talk about tonight is talking about two main things. We are mainly, or at least people here mainly, small cap traders, okay? But I didn't start with small caps. I started with big caps almost 2 decades ago. And I was trading, before even trading equities, I was trading warrants and covered warrants and options. So basically, I built a lot of my capital from that. Especially I was using covered warrants, which are almost the same thing as options. At least in Italian market are the same thing as option in the US. So why options? Because it gives you the possibility to have a huge return with a small move, percentage move of the underlying stock. What I mean, generally, and this depends from the option that you choose, but it can happen that you have 1% move on Netflix and your option will go like 30, 40, 50%. So you can see a day that, like yesterday on Netflix, we dumped more than 20 bucks. The option can go like 300-400%. And you don't need, like for Netflix, you know, if we look at Netflix today, what was 290, 300, yeah, 290. You don't need to buy 100 shares and pay 29K to buy it. When you go on option on Netflix, if you get some in the money, so we start like looking some puts, and then I will describe everything. You basically need like 1/10 of that, so like $2,500, $3,000 to buy one contract, and you can like sell it for 2, 3, 4 times more in the same day. Okay, so whenever you want like to build your account, don't think that the only way is with the small caps. The fact is that even 1, 2 contracts can bring home a paycheck. So let's look together the main things you have to know. So options are the cheaper way to play big caps. This is it. When they talk about premium, you know, you will see in rooms or Twitter, that's the cost you buy, the cost you have to pay for the option. And there are mainly two things, calls and puts. Calls if you want to long the market, puts if you want to short the market. The strike is the price you think it will go to exercise your option. And whenever we're talking in the money, is basically, example here, we are like 288. So puts in the money and out of the money. So you will see that the price out of the money, they will be like cheaper. Okay, so like right now 288 on Netflix, puts out of the money are cheaper than the one in the money. Okay, so you will pay a lower premium for the out of the money compared in the money. Then we have delta and all other things. But what's more important is to choose the option. So basically, you will see people like playing strategy, straddle, spread. And the main thing that you have to look for is to choose the option in relation to the price you think it will go. So if you think that Netflix, example, these days at 300, you see this downtrend, you think that this will go like 280, play an option 280 put. You think this will happen in 1 month or in 2 months, choose a longer expiration, so a longer time frame like end December. Okay, so remember that two things: to choose your options, you have to know where you think the price will go and when it will go. If I trade intraday, I basically don't have this problem. I will like look into the weekly options. So every Friday you have the expiring of your options. And I will look for the next target. Yesterday I was playing Netflix. Actually, my mother was playing this, and we will look why soon. But the price was basically here at 300 when she started shorting, and she was looking for target 270. She was playing in 285, 280, and 275 puts. So I always have used TC2000 to see like the option chart, okay? But you can basically use everything, okay? So just to give you an idea, this is what Netflix did yesterday, okay? Let's look at 285. And basically tend always to see the most traded option. So you see today the most traded was this one here, 285, and this one here, 280, because people were thinking that this would have gone so much lower, okay? So basically we see here how it moves an option. While the price of the stock went from 300 till a low of 280, the price of the option went something like from 275 till 9 plus. So you can see how is the difference in percentage. So basically, you want to see Netflix short because the trend is short, because everything is pointing down, because the Qs and the SPY are pointing down. Then you look the most traded option weekly, because you're gonna probably nail it for 1-2 days, okay? And you're gonna basically trade that. So it works like a bid and ask. You buy it, okay, and you sell it. That's it. The only thing is that instead of having the price here 300, 295, or whatever, you have basically this, okay? You have basically this. And that's it. It's so simple. So what I do, put my stock, and I put the underlying option, the relative option to it. And that's it. Today, I want to talk about two main strategies that I use. So first of all, I want to look into Netflix. So when I look in big caps, I trade both long and short. But I don't know why when it's short seems like to be always going smoother, and I prefer short for that. So I buy generally puts. So the first thing I do when I see a big cap is to see where this is comparing to the 7289, which are my two Fibonacci expansion EMAs, where the price is if above or below. And I use, you can use whatever, but I use basically this line, 9 EMA or 13 EMA, whatever you prefer, to see the intra trend, I call the mini trends. We see basically here from the 9th of November, the price shifted and started below, and it's going down. So let's look what happens with our stock. So basically, we are here this day, the 9th. So basically, each pop I will have, it will be a short for me because we are below these two EMA, and because we have this mini trend that is starting to form, is opening below the 9 EMA. So let's go to see in depth. You see, when we start in the morning, I will always see a failed push. You will hear me talking about failed push. So when you start basically, and you see this stuff, You can use a 1, 3 minutes, 5 minutes, whatever you want. And then I see a fail. That fail is my short. Generally, the confirmation of the fail will be when this loses the pre-market support. Okay, so basically a fail push, tier 1, adding tier 2 and tier 3. Okay, or basically shorting 1/3 and adding here 2/3. And this always has to be below the 9 or below a 5 or below 13, whatever you prefer. But you have to know that this is a mini short or downtrend. So the day after, we start basically looking here, and we have a push, but here continues like to be above the 70.29. What happens over here, that it dumps and then start rejecting. So this one here, this level here on the reject, this is another short. And when you see this here, 294, okay, and here you have a dip till 289 and 50, 290. You see here these $4. Well, these $4 can be like a 100% on your option. So how to choose your option when you are here 294? Okay, so basically this is 3 days ago. Let's look together. Let's put just a 3-minute chart. So basically here is the 13, which is this day over here. And you have to look when the price here is 294 for the bigger whole round number. So you have the 290. That 290 will be my strike price. So this was 3 days ago, but this 290 is my strike price, and I will look to short into that. Okay, in this case, that will be my put. So let's go to see yesterday, because this was the move I want to talk about. And this is like my favorite scenario. When you have a mini trend, guys, and remember this good, look for the close and for a gap up. So in pre-market, you already know that this is gapping up, okay? But you're in a mini trend. So this you can play on all the stock you love, Apple, Netflix, Google, AMD, Twitter, or whatever you want. But you have mini trend, close, gap up, wait for that failed push. You see this failed push? This over here established a high. And then each pop that will go and would not break this level, it's a short. Short with this risk. So this 350, this 299, 250, and all this area here is a short with this risk because we established a top, okay? And then you will go basically look at your option. And you can see, example, here we are at 300. We will looking for 295 or 290. So let's go to see a 295. Pretty expensive premium. But you basically buy this around $650, $7 per contract. And this spikes up at 13. So you have basically 100% move in not even a couple of hours. So this is how they move, okay? No reason to buy, 100 shares, 200 shares, 300 shares, 1,000 shares here. Just buy one contract. So this is basically trending Netflix or trending stocks, something like Apple. Another thing I want to show instead is another setup. And for me, it's an A+ setup. When I see this kind of setup, I tend to load the boat. So this was PBYI 2nd November, okay? I want to show you the day because I played this. This was a big gap. So whenever I see a gap like this on bad earnings or bad news, it can have like a fraud sentence, can have like any kind of bad news coming, like PCG lawsuit filed, the price will gap down. you will have a pre-market where you would set a pre-market high and pre-market low. Well, here we didn't have a failed push, but we had a breakdown. So on every time the breakdown of this pre-market low, that will be my trade. And look always for the second day fail, because on the second day, you could have still the same pattern. This is another example, same kind of setup, WTW, pre-market gap down on bad earnings over here. We establish a low here in pre-market and a high over here. So on this breakdown of the pre-market support, and even here in the rejection, you enter short. And where will be your targets? Your target basically, when you don't have like AMAs, because they are all like above, you have basically to use daily support. So you go to see the daily chart, or whole dollar numbers. So 50, 55, 60, and so on. Those will be your triggers for the exits. The last thing I want to show, and then I leave the word to Dell. We will look together how the options went on this, guys. So PCG is a stock that yesterday really nailed it good with some guys in the room. We know bad news on this. We know how this is like below the 739, is below also the daily 200 AMA and 200 SMA. So really is shifting bad, okay? So we know that there's a negative sentiment. And here, yesterday, we were exactly over here. And this is the same chart. We saw basically this dump in pre-market, put in here pre-market low. So the first thing you have to do in the morning is set your pre-market low and setting your pre-market high. This is a pretty big range because we have like $8 on this. So remember what I said, that on this bad news, I want to see a fill push or the break of support. And here you have a fill push right in the morning where we establish a top and right here a lower high. So from here on, all these pops that we will have will be like entries risking this high over here. And what happened, how to choose the puts on this. So let's go to see PCG. We are basically here around 28, so we will be looking for 25 puts. Let's go see 25s. This is puts expiring 16 November, so they are weekly because they end this weekly. And these other ones, we're calling them monthly. So we have to go see basically how both traded. So here we have premium of $7. You see how this is different, how much more premium you pay compared like to a 300 strike put on Netflix, because they make you pay on these more liquid stocks that amount of premium. And you see basically here, once it made this top, okay, yesterday you could buy this option at $1 and it went to almost $4 on this dump. So you can see how these move. And remember what I told you on this bad news, bad earnings, look for the second day. Second day again, trace your pre-market low, pre-market high, and here on the break of support, you have your other entry and dump. And look today what it did. So today the price was at open at 25. So we will be looking for probably lower strike. So if you go to see basically lower strikes over here on the weekly, you see basically nothing, no traded. If you go to see here next week, you will see starting around 2 went to 450 and still coming down. So this is really like, I would say, like the magic of the options, because you don't need to invest $22,000 or whatever to buy 1,000 shares. You basically need to invest like six, $700 to buy one contract, which is a big difference. What do you think, Del?
Yeah, absolutely. I was just answering some questions and some people just confused in general about options and the basics. So what I'm doing is I'm just sharing with them a link to YouTube where I just searched option basics. And if someone were to go and just watch those videos top down, even the first few videos, they'd understand the basics, and then they can come back and rewatch this webinar. But yeah, I see what you're doing on the charts, and these are killer setups. Just killer setups if you can catch them at the right time. It's especially with options, it's all about timing.
Exactly, exactly. And guys, you will see many times that on options, you don't have time to put limit orders. Okay. I know a guy, Smash, my friend, he's very good trading options. I will like suggest you to go follow him if you're interested in options. And he loves to put like limit orders. He's a beast on this. I prefer like more to use market orders. Example in these liquid ones, like today a P24 on PCG went basically from $2 till almost seven, guys, almost seven. Okay, so this incredible moves, and you need to buy like two or three contracts, five contracts, 10 contracts, not that much.
Yeah,
Like with already 1,000 invested, you can have a very good return.
and if I could just like last week I took an options trade on TLRY. This is a wheat stock when the cannabis was going nuts, and I didn't even catch the beginning of that move last week, but I did jump into an option that I saw that wasn't moving yet, but I knew it should have been moving. So it was basically worthless. If you picture an option like the further away it is from price, the cheaper it is. I bought that really cheap, and I knew that as price was continuing to explode higher, that my option would become a bit, more and more valuable. And I traded it from 85 cents all the way up to $9.50. And that's the type of power that there is behind options if you understand them and how they move.
I remember the day I was with you, and that was a crazy move. So, guys, basically, what Dells is saying is that he bought an RTZ option. The fact is that he was buying cheap option like sub $1 per contract, means that one uh, sub $1 means that one contract would cost below $100. This is so if you buy like 10 contracts, let's say $1 premium, that will be $1,000. But with his investment went more than 1,000% in that same day, okay, he brought home something like $10,000, okay, with only 1,000 of investment, while you need a big buying power to buy TLRY, pay the fees, and that's crazy fees. I pay a bunch of fees lately on TLRY to have not even the same percentage of return. Okay, Del, you want to talk now about your setups, and I leave the word to you, okay?
Awesome. Yeah, thanks so much, Jay. It's been really great there just seeing the strategies and how deep you go into each of the strategies. Now, one thing that's really powerful about JTrader's strategy that I find giving you my opinion on it is he's incredibly consistent in the way he trades. And I'm talking very, very, very rules based. And this is the only way to extract any type of statistical edge out of a out of a trading strategy. Imagine having to take a trade 1,000 times over. How many times out of 1,000 times would you be winning? If it's more than half, then you're for sure, even with poor position sizing and risk management, even still you're probably going to make a profit. The majority of traders will lose around 75% of the time, and with poor position sizing and poor risk management, that is a nightmare. But with good position sizing and good risk management and proper knowledge of the markets and everything JTrader has been talking about, Even if you do the strategy wrong, you can make money if you mind your risk. So just a
Absolutely.
couple words on that.
Absolutely is like this.
So I just want to run this poll quickly with you guys. Let me just share my screen here. Make sure that it's shared. Just want to run this poll quickly with you guys, just so we get an understanding of the people and where you are with options. I'm going to launch the poll now, and you should have that on your screen at the moment. So and it's pretty cool actually. We can see all the updating there. And the question is, how comfortable are you with options? A lot of people are confused by options because you can get really, really complex with them. And like JTrader the strategies that JTrader is talking about, they aren't incredibly complex option strategies. You're literally buying calls and buying puts. Buying a call is thinking that the stock is going to go long, right? So call, if you buy a call, you're thinking the stock's going to go up, and if you buy a put, then you're thinking the stock's going to go down. And that's all you really need to know when you're looking at the options chain. Now, second to that, obviously you need to know how the option chain works and some more basics around options. But anything more advanced than that, like complex option strategies with multiple legs, butterfly patterns, condors, that type of stuff, you don't need to worry about that. All you're doing is riding momentum on the underlying stock by buying calls or buying puts. So think of that, and then go and do your own research. You know, I always recommend um, traders do their own research in Google, and I think the most successful traders are the ones that are out there Googling constantly, have 1,000 tabs open, managing the way they learn, and that's what you need to do as well. So on bear versus pig, the whole idea is to make sure that the information that comes across genuinely at the level at the level that that particular trader is at, and they're not dumbing things down for your sake, because all this stuff can get very complicated, and it's just important that you understand that you need to go do your own research if you want to be successful. Great. So how comfortable are you with options? The majority of people said not comfortable at all, and great, because if you said that if everybody said they understood them, um, you're all liars. Like I trade options, and I have a very hard time explaining to people what options are. So that's my piece of advice for options.
Yeah, guys, the only thing I suggest you is not to make it difficult. Really, I would have liked I was really 19 when I started trading cover ones, which are the same thing on options. We had that on a European market at the time. And it was basically only looking at the stock with the options chart near, okay, and price of the option, and basically trading, looking at the stock, but using the option. That's it. That's it. The only thing is you have to find a good option that follows very good the stock. So basically, if it's like Netflix today, 300 the price, and you're looking to short it, I will go with a 295 and 290, um, the most liquid options um, to trade. Generally, I like to trade out of the money. I want to pay a small premium. I don't want to pay expensive options. And the more these are out of the money, the more I will like swing strategies for them. So it means that if I'm looking for the next 2, 3 days to short Netflix, so buy puts, I will be looking for a larger out of the money strike, so like a 270, 280. And that will be less expensive to buy in the money compared to buy in the money options. Therefore, I can risk the money that I put inside there. Let's say I pay $500 for that will be a $5 contract, okay, premium. So I pay $500 for one contract. So I risk those $500, but that move will give me maybe 4, 5, 6 times what I'm paying. So I will get like maybe 2,005, $3,000 back if my investment will go good. So it's not like playing casino. but it's like knowing your odds, knowing that if you have a good strategy, option on the long term will pay you much more than the stocks.
Exactly. Very well said. And I was just trying to help what you were talking about by drawing some stuff on the screen. So I hope that made sense to people. But anyway, enough about the option stuff. I mean, we could have an entire webinar about explaining options. I think the main point is, go back, watch the recording of the webinar, and pick apart JTrader's strategy there, because that's the way to properly risk and position size yourself and in the market using charts to make money using options, um, especially for that small account, right? Okay, great. Um, all right, so now that you've got somewhat of an understanding for JTrader strategy for using options to trade, um, and I think a lot of people are still going to be in that zone where they're testing and they're going back and forth and they're looking at the chart and they're looking at the options chain and they're not really sure what to make of it. Once you figure out, uh, once you connect in your mind the options chain to price, then you can start thinking about strategies that you might want to implement, and that's where JTrader strategy is going to come really, really handy. So what I want to do for you guys is I want to help you understand the way I break down a chart from a top-down analysis using what I like to call market auction theory as opposed to the classical auction market theory. And I also want to talk through some structure and some basics. I also want to kind of help you unlearn some of the things you may have learned in the past that are bad habits when it comes to charting, and also a bit of a change in mindset. Now, I did get all of your questions, so don't worry if your question hasn't been answered yet. We're gonna go through at the end, and we're gonna walk through the questions and answer them all the ones we can anyway for you. Okay, so first things first. And just to be clear, I'm showing you how to break down a chart from the top down so that you can implement whatever type of strategy that you want, including the option strategies that you just learned, um, with a full understanding of the chart. Okay, so two things I want you to understand very quickly on the chart that you're going to see, and everything else I don't want you to worry about. You'll see that I trade with what's called a naked chart. I do have some moving averages and all that that are on the screen, but for the most part, I trade with a naked chart, and the averages are just helping me gauge, from a higher time frame, the direction the stock is moving. That's all. So volume at time is one of the indicators, the main volume indicators that I'll be using. I use that. That's the one that you always see at the bottom of the page. So we've got time at the bottom, and then we've got um, each one of those time periods lining up with the candles. So if you've got a 1 minute chart on Apple, one of these sticks will be 1 minute's worth of volume at that particular time. And if you've got a 5 minute chart of Apple, then this will be a 5 minute bar, right? And the power in having volume at time at the bottom of the page is that you can see relative moves just by visually looking at it. So you know that at 11:10 this move in Apple was a lot bigger than the move at 11:20. Cool. Next thing, very simple, just basics, is volume at price. So this is what people normally call volume profile because that's what it is. I mean, technically, the volume at the bottom of the page is also a profile, but we'll just say that this is volume profile. I like to call it volume at price because, volume at time, volume at price. And this is the exact opposite. So this is volume at every particular price level, how much volume was deposited at the particular price level, either inside of a period, of maybe like your charts view, right? So every period inside of this chart view, calculating all the volume at that particular price, giving you that histogram on the side of the page. And the other way you can look at it is intraday volume, which looks like, let's say this was the 9:30 open. then the volume histogram would start filling out here depending on where the start of the day was, and it would change as you got to, let's say, 4 o'clock, right? Eastern time, which is the close of the market. And then you've got maybe another one for the pre-market. So that is volume at price and volume profile.
It's clear.
Awesome. Oh,
I'm also listening here because I'm interested in this.
good. Every time I feel like every time I explain this stuff, I understand it a little bit more as well. So I love explaining it. Okay, so here's a chart of the SPY. I'm very busy on the SPY right now. I'm using all of my powers to try and figure out what the SPY is doing. But what you'll see on the chart right now is, the volume at price and then the volume at time. And this is on the 5-minute chart. And the areas in the middle here, the slightly lighter areas, are all pre-market and post-market action. And you'll see that volume is non-existent inside those areas, and it's because um, volume isn't really collected by most. Um, I don't know the technicals too much, but I think by most exchanges, it's not really like shared or at the level that it is when the market opens up. So you'll see a large influx of volume. But I bet you that a lot of these pre-market days are almost just as full as some of the in-market trading times. Um, okay, and then just one more thing at the bottom of the page, the one indicator that I like to use, and the guys in my trading room at activetraders.chat, they know that I like to use relative strength index. So this is the RSI, and it's just the base RSI, which I think is the 14 period, which basically goes back 14 days and calculates the relative strength index. It's an oscillating index, so as you can see, we've got 50. Price will often return to 50. If the price moves sideways, it's going back to 50 basically. It moves up, then as the strength goes up, it goes out to the extremities and in either direction. And I basically use this to not to try and time the market, but to have the market tell me whether the strength of a move is overbought or oversold, and that is likely to have a retracement back to the mean, which is the 50 mark on the RSI. And that's really all you should be using the RSI for. There's some techniques inside of the RSI that you can use to try and identify trend changes. Like one is RSI divergence. So divergences meaning as, let's just pick one here. So let's look for, let's say this one here. So if we see this high here, we know that this is an extremely overbought high because the price of the stock has began to move higher after a relative high move. The RSI shows that relative move and then shows that the the angle at which the next peak on the RSI is actually lower or beginning to go lower than the peak on the price chart. Sometimes it's really obvious, like sometimes you'll have the peak be like this on the RSI and the peak be like that on the price chart, and it shows you that there's an extension that's far beyond where it should be, and that's what they normally call overbought, and that will usually lead to a reversion on the RSI back down to the mean. This technique works with the volume histogram sometimes as well, and it also works with delta, price delta, and that's how many orders have been added or removed from the market in an accumulated delta. So, and just to clarify that, this meaning price higher and the RSI lower on the peaks, let's say. This is what they call um, uh, bearish divergence, right? When it's out, it's bear. Excuse my writing. When it's out, it's bear, and then when it's in, when the prices are looking like they're moving inwards as opposed to outwards, then that is what they call bullish divergence.
A question for you from me, Del.
Shoot.
You use this often every day, right?
I use it every day. Yep.
Okay. You know why, guys? I say because I always see Dell coming up to me and say, "Oh, divergence, divergence." I say, "What the fuck is this? Always divergence." And then I start incorporating also in my trading. But actually, trust me, both small and big caps is so damn effective. Really, it's not bullshit. It helps you anticipate the trend, the shift. Go on, Dell. Sorry.
Yeah, exactly. That's what it is. It helps you anticipate the shift. Now, using divergence on its own to try and identify a shift is probably suicidal for your account because there's nothing that says that this divergence can't keep getting wider, right? So that's why it's not used for
True.
timing. It's just used for sentiment. Okay, so that's enough about the RSI and divergences. Let's get back to the volume profile stuff. So volume profile, I traded futures for many years. I traded crude oil, gold. I traded the ES as well, the ETF. In the world of futures, I learned from James Dalton, who's one of the main architects of market auction theory, or auction market theory, I should say. Futures Trader 71 is another guy that uses volume profile analysis a lot. There's also another method that's used a lot in futures that's very popular with volume traders, and it's called the Wyckoff method. And basically, just I mean, I've gone through and I've gone through everything you can possibly think of, advanced patterns when it comes to like Fibonacci, like Gartley and Bats and all of the crazy stuff. I've gone through Elliott wave theory. I've read books on Elliott wave theory, and I was sort of a technical junkie. And I was lost for many years because I mean, there was so much stuff going on in my head. I didn't know how to pick it all apart. So I decided to create market auction theory, which is my own version of dumbing down everything and taking only the pieces that work and plopping them into a strategy that works cross market. Now, when I was trading futures, I learned that number one, knowing what goes on behind the candlestick is the single most important sort of tide turning thing that you can do as a trader is fully understanding what's behind a candlestick, what creates the candlestick, and then understanding how useless candlesticks become when it comes to, compared to the rest of your analysis. Secondly, the other thing you need to realize is that um, trading a chart, you are not, and I'm going to just explain this very carefully to you guys. This is probably my main turning point in trading when I started becoming profitable, is just understanding that technical analysis itself is not about predicting future price movements. You are not predicting where the price is going to go. That is, if you hear anybody tell you on Twitter or whatever that this is where price is going to go, start putting money behind it, they're a charlatan. Technical analysis is about defining market sentiment and identifying future areas of conflict on the chart. So you're using the past, everything that's happened in the past, to identify price levels that if price reaches that level, that there is going to be conflict. You're not saying that it's going to go higher from there, it's going to bounce from there. You are saying that it's going to be conflict. And what I'm going to show you next will be you're going to be able to make a educated guess as to the likelihood of price spending either the most or the least amount of time at that particular price level. So just think about that for a second. If you are able to, as a trader, say that, let's say 275 on the S&P, just as an example, let's say 275 on the S&P, if price reaches that level, that there is going to be a reaction from the market. You can say that with complete certainty. And that when price reaches that level, it is most likely that price is going to spend either a lot of time at trading at that level or only a little bit of time. So let's uh, let's go into that and talk about, I guess, the basics of volume analysis, and I will give you this really quick way to do a top-down analysis of the market right after I explain to you distributions of volume. Let me go back here 1 second. Okay, so we showed you the histogram on the left, we showed you the histogram on the bottom, and why am I so focused on volume? There's only really three things that you need to worry about and you need to be fully aware of on any chart in any market. It is time, price,
And volume.
and volume. And that is, oh, that's volume.
Guys, he's drunk. Don't worry. He's always like this.
So time, price, and volume. Um, if you understand time, price, and volume, you don't need indicators. You don't need some guru telling you um, to use their specific indicator that's going to give you all the answers, because you will have an understanding of market sentiment. So all of this equals market sentiment. All right. So volume we identified, right? Price is the last thing we're going to identify. Don't worry about that. And then time is something that we're going to go over right now. So time is now think about this. Time is the amount of time that that price will spend at a particular price level. So if you've got price moving around all day long, doing crazy moves, and then all of a sudden it gets to a level and it starts ranging inside of that level, and it starts putting in some kind of a, what they call support or resistance, then and price leaves that level either to the downside or the upside, you can be sure that when price returns to that level, that there's going to be some kind of an effect, right? There's going to be some kind of a conflict there. And it's just because of the fact that price A spent a lot of time there, and B deposited volume at that level over and over and over again. And that creates this sort of ripple effect in the market that goes off into the future. And when price returns to this level, even years later returns to this level, you know that there is likely a high likelihood of more conflict at that particular level. So that's time. And this is the only thing you need to worry about right now when it comes to this time price volume analysis. The last thing you need to know before we do our top down is a distribution. So I've shown you volume on the side, volume at the bottom. I'm just showing you volume sideways right now just because I want to show you volume sideways. That's it. So let's say this is the volume curve. Okay. So this is what they call a distribution of volume. This is what they call a balanced distribution of volume. Meaning if these are the price levels below. If these are the price levels below, let's say 0, or let's say 50, let's say 0, and this is 25, and then we'll say this is like what, I don't know, 15. This will be 35. I know that at $25, the most amount of volume, let's see, there's a like peak in there. The most amount of volume was deposited at $25. And then the least amount of volume over a particular period in time was deposited at $15 and at $35. So we call the $25 mark a high volume node or point of control. And we call the low volume areas, price levels that were barely touched by the market, LVNs, I like to call them, low volume nodes. And these are areas in the market where there is technically the least amount of value. So if you look at it like in terms of value, when somebody spends a lot of time at one, or when a group of people spend a lot of time at one price level, trading at one price level, that is the most popular level, right? Popularity. And that popular level is important. It's important. It'll be important in the future if price ever returns to that level. Whereas a less popular area is what they call least fair value, isn't really popular. And if price were to ever swing up into that low volume area or low value area, nobody wants to trade there because it's the most unpopular level, right? So imagine a lunchroom with a whole bunch of kids and a bunch of different tables, and all the geeks are sitting at this level right here, and all the cool kids are over here. So all the cool kids are probably going to get all the attention from the babes, and the nerds are just repelled by the babes. So the prices are the babes. Okay, so just think of it like that. Kind of a different analogy that I've ever used, but I like it. So that is a volume distribution, and just keep that in your mind, right? So one more time, as price reaches areas that are of unfair value or fair value or most popular value, price is going to want to spend more time in the popular areas than in the unpopular ones. That is the basis of market auction theory and what I teach at activetraders.chat with my team. All right,
That's a good one, Dell. Thank you, bro.
awesome. Glad you enjoyed that. Um, so now I want to show you guys the top-down analysis that I promised you. So I'm going to walk you through a chart. We're going to go basically out from, let's say, the highest I can, the monthly, and we'll go down from there. I'm going to use a slightly different tool because it's a lot clearer and there's less junk on there. Let me clear this out. And just one more thing. If you guys are looking for the platform to use in order to see volume distributions, please, please, please do not use programs that don't give you detailed volume information. So I'm going to go down to the 1 minute on the SPY, and I'm going to zoom all the way in as basically as far as I can. Look at the size of each of these bars here at each price level. Per penny information on volume. Some platforms, I'm not going to name the platforms on here, but some platforms do not give you this level of detailed information. And you'll see that as I scroll out, the profile gets thinner and thinner and thinner and more detailed. I need this level of fidelity when I'm reading um, volume profile. I just need it because I'm identifying areas of low volume and areas of high volume. And if your chart looks like this, when you've zoomed out on or added volume profile, just go ahead and toss it inside of your garbage can because it's completely useless. All right, so programs you can use, TradingView is one that I use. I love TradingView. It's great. It costs money. Everything good in this world costs money. And the other thing you can use is Thinkorswim. So Thinkorswim is free if with a deposit, I believe. So I'll let you just go and figure that out and explore. A program that I've been using for a while, actually made here in Canada by a Canadian, is MotiveWave. I've owned this for a really long time. Don't go out and buy it with just because I have it. I don't know if you would do that. Not because I won't get any royalties from it or anything like that. It's just there's cheaper ways. Um, so I'm going to use this to go from monthly down. So let's go out to a month, let's say, on the Qs. Actually, you know what? Let's do something even better. I want you guys to tell me what stock. I wonder if you can do that. I'm going to jump into JTrader's room. Let's see if they're listening. Maybe somebody wants to drop out a name of a stock. NBEV. Okay, Andy K suggested NBEV.
Yes, MBV.
Just to show you that I haven't really prepared a chart specifically for this because it fits my style. I hate when that happens in webinars.
Guys, it's all set up. It was like all set up. Don't trust him.
Good job, Andy. Right on time, pal. Um, okay, so we're gonna go out to the monthly here on NBEV. So first things first, top-down analysis. I'm going to use volume profile, I'm going to use structure, and I'm going to use my time analysis. Okay, so monthly, as far as it goes back on NBEV, first thing I notice is that higher time frame, this stock is moving higher. Okay, so what is my bias? My bias is bullish if I'm trading on the monthly. And if I'm trading on the monthly, I'm seeing price pull back here. I'm thinking, okay, maybe there's a bottom somewhere and this thing's going to turn around. That's my mindset from the monthly. Now, looking at the distributions of volume, I'm looking at a couple things. Number one, are there balanced distributions of volume? Does the distribution have that beautiful curve in it, or is it like an ugly beast, right? If it's an ugly beast, then it's most likely that price is going to come back like a little worker and fill in those gaps. It's going to come back and spend more time inside of that area, filling that area to try and make the distribution look balanced. Okay, so this is a pretty balanced distribution right here, and it's sort of like a health check, right? Think of it like the health of a distribution. So this one's pretty healthy. This one's okay too. This one definitely needs some work. Garbage. All right, so that's the monthly. So my bias on the monthly is bullish. I haven't picked out any levels. Oh yeah, one more thing. Please do not try and identify important levels by how many times price has touched that level. The classic way of looking at support and resistance is okay because you're sort of identifying areas on the chart that are important, but you're not really getting down to the understanding of why that level is being touched over and over again until you understand the volume. And once you understand that it's the volume that's creating that support or resistance level and not, like one touch, second touch, third touch, support turns into resistance type of stuff. We're talking about deep volume understanding, knowing that where the fair value is, and knowing that price wants to spend the least amount of time at that nerd's table, where they want to go to the more popular area where all the consolidation is. All right, so rejection, acceptance. Rejection, right? Price rejecting these low value areas, and price accepting the high volume areas. Okay, so looking at the weekly chart now, I can start seeing a little bit more fidelity here. Um, bullish, bearish, bullish, and really bearish. Why really bearish? Because price came up all the way to test that really nice distribution of volume that we had and deposited very little volume at the highs. Price is telling me that it doesn't really want to spend too much time there, that those prices aren't enticing enough. And it uses the momentum move back to the downside to cross the high volume areas and explore the lower bounds of that value. And that's where you see that really big sell-off, price spending, gap it down, right? Gap it down and then sell off, price spending the least amount of time, the least amount of time possible inside of those low value areas. So if I'm a trader and I'm looking at trading this on the weekly and I see that price is maybe around the $7 level and it's looking like it's continue going lower, I'm saying to myself, if price accelerates, I want to jump on board and I want to see if price rejects this low volume area like it did in the past, right? Rejection, 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 um, and bounces or just breaks through. Obviously, breaking through if I'm short is the best possible scenario, but maybe I want to take some profits there to protect myself and hold on to a runner to see if price will break through that low volume area and break down. And if you're using options or using JTrader strategies, you can take a look at the higher time frame to see that top-down analysis and see where the bias is to the downside. Where's the popular table and where's the geek table? And then that'll help you with that. So now we've got bearish short-term sentiment, bullish long-term sentiment. And then I'll run through the last ones fairly quickly because I think you get the gist of it. Down to the daily, right? I'm not squishing down the chart as far as I can anymore because it's not really that important what's happened in the past. I've already identified that. I know that these levels here are important, the ones where the distribution is. And now I'm looking at in more detail this move. That's where I want to get more fidelity in. So what's happened at that inside of this one particular move. If I'm using the volume profile where it fills my chart and it gives me the information inside of the range, I'm looking at the distributions. Right now I get more fidelity inside of the distributions. What needs more work? This area, it's kind of gross. That needs more work. This one's pretty well defined. There's a really nice point right there for the point of control, right? That's really nice higher time frame point of control. Marked it off on my chart, and I can see that prices below has tested these low value areas and is likely coming back up to test the point of control from that distribution. So now I've got a bearish sentiment. I can draw a trend line. I know that there's a point of control up above. I know there's a balanced distribution up above, and I know that price needs more work to the downside, right? So you can see where I'm going with this type of analysis. And the faster you are at going deeper and deeper, the easier it is for you to go from the 4 hour, maybe down to the 2 hour, maybe down to the 15 minute, and identify even down to the 1 minute this works. It doesn't matter what time frame you're on. There's always distributions of volume to analyze, and there's always low value areas and high value areas. So there you have it. That is the top-down analysis of the market, and then you can use that to always follow your bias um, based on your analysis. And if you want to say enter a trade like this using options on maybe it's another stock like a Netflix or something like that, you'll have even more volume information because there's more volume, and you can use that top-down analysis to give it to you. And the 1 minute chart here on NBEV, we know that it's been bullish, but you know the levels that are up above. You know where the low value areas are, and if you see price reaching that low value area, maybe let's say that price was reaching this low value area into the high of the pre-market session, then a good risk opportunity would be to maybe start shorting into the test of that high volume node and having your stop at the rejection area of the low value area. So at activetraders.chat, as part of the course that I put together, I've got about I think it's close to 4 hours of video training. I walk through this top-down analysis, but in more detail, and we have very specific parameters and very specific setups. We only trade 3 setups: the AT1, AT2, um, and our AT3. And these are the 3 setups that, using market auction theory, work best for this specific type of analysis. And we track and we trade these every single day in the small cap market. So that's that.
Thanks, Dale. It's time to answer some questions, bro.
You bet, man. Let's start doing that.
Okay, so you want to start from the beginning?
Yeah, you bet.
Okay, let's see what we have over here.
Let's do this thank you screen up.
So first I have Brian Lilly, right? Let's see. Option.
Do you want to read it, or do you want me to read it?
I can read it. Options are generally a riskier investment than simply buying or shorting the underlying equity. When you play in options, are you risking the entire amount of the premium, or do you have stops or your option play? You want to answer this, Del?
Yeah, sure. So when you're playing an option, what you're doing is you're purchasing a piece, a piece of the potential of the underlying stock. So let's say you buy one contract at, let's say it's at $1. This is a pretty expensive option. Let's say you buy that. What you're actually doing is you're buying one contract at $1 for, let's say the stock is at $50. It doesn't really matter what the strike price is in this example. So one contract at $1. What you do is you take that $1 and you multiply it by 100, because every contract is worth 100 shares of the underlying stock or the underlying asset that you're trading options on. So if I bought one Apple contract at $1, I'd have to multiply that one contract by 100, and that equals $100. Now the question is, are you risking $100 can you lose all of that? Technically, yes, but um, what you do is because this contract will expire, let's just say it's in 7 days. Um, there's value in this contract all the way up until 7 days, or all the way up until it's a certain distance away from the underlying price. So all that's to say is that it's not like you buying this contract will automatically put you $100 in the hole. You will have a P&L curve that starts moving as soon as you buy that contract, and the maximum you're able to lose is $100, right? So at some point in this time, maybe it'll be worth zero, but it'll never be worth less than zero. And if this period is 7 days, then you could sell it here, you could sell it here, you could sell it here, whatever, and not have to eat that entire loss all the way back down to zero. So that's the answer.
Okay. Next question. Can you describe how much options play a role in the overall stock price action? I don't know what this means, bro.
How much options play a role in the overall stock price? Oh, okay, yeah, I think so. I think I know what that means.
Okay.
Okay, I'll give it a shot. So, um, delta is something that you might be talking about here. Um, actually, let's not get that technical. So the option, if you have an options chain and the option chain is like $50, $100, 150, let's say 200, and the actual price of the stock is like like 110, and you buy a stock that's all the way out at 200, it's going to be worth less than a stock that is at, let's say, 100. And so um, if the stock price has a volatility where it normally moves $100 at a time, like it has a crazy high volatility, then this stock is going to be worth more, and each price movement is going to be affect the stock price even more. But if the stock only moves like a little bit, and it maybe takes like a long time in order for price to reach that level, then the stock's going to be worth less. So I think that's the answer to your question.
Yes. Let's go with another one. Do you spend much time on the Greeks while they're trading weekly options? Can I answer this?
Yeah, go for it.
Not really, guys. I'm very direct. I like to trade options, call if the price I think is going up. I like to play puts if the price is going down. That's it. That's the only way I look at them. So, don't you think, Del, or you pay a lot of attention at Greek? So delta,
No.
gamma, theta, and all this stuff. Basically, guys, you have to know that delta is the amount that is moved with $1 change in the line in stock. If you have a delta 0.70, means each dollar the stock move, the option will go like 0.70 and so on. So I generally don't look too much at this thing, delta, theta like this. I look the most liquid options, and I just see the chart and I see comparing to the stock how much this moves. That's it. It's very simple.
Yeah, that's a good answer. Unless you're using complex options, you don't have to worry about too much. And unless you're holding it for an extended period of time, like you're buying it like 4 or 5 months out, then you might have to learn a little bit more about that. But for day trading to short-term swing trading, don't worry about it too much.
Another question from Aaron Stednick. When looking at the FANG chart, do you primarily base which ones to trade off the daily levels? I notice some traders trade Netflix every day, for instance, so it is more beneficial to play off daily levels, or you just work one stock over and over? If I have to answer this, I have some charts that I trade each day, some stocks I trade each day, like Netflix. I look often to Facebook, those two mainly. So I basically know each day the most traded Netflix options. I tend to rely on them. I know how it moves. I know how the options move. So I'm basically like, trading, at home. And then, yeah, I trade like new gaps or new setups every day. You
Yeah.
want to answer something more, Dell, or
Oh
should I
yeah,
go
I
on?
just want to mention Smash the Bid. So Smash trades Netflix every single day. Just like in the podcast, he was talking about this in particular. So I definitely suggest looking him up. I haven't really been trading daily intraday options that often, and I really just started getting into it a lot when I met or I spoke with Smash, and I sort of promised that I'd get into it, and I did. So now I'm loving it, and I'm having a lot of success with it. But if you want to learn about Netflix, JTrader and Smash are the guys to talk to.
Then another question. Actually, they're asking how you can be so beautiful for having so many years, brother.
What?
No, let's be serious still. Long day over here. So, trading is a race between, for you, Dell, your entry point and your level of conviction. Dell Trader, what do you mean?
Oh yeah, that was a tweet that I tweeted out last week, I think. I tweeted that out because I was just thinking about a trade that I'm taking in the SPY right now, where I was short the SPY. I was talking about it and kind of like bugging the guys in the room over and over again about this S&P 500 short. And the reason I tweeted that was because as a trader, your number one thing is to convince yourself in the trade so that when price reaches that level that you've been eyeballing, you have the conviction or the balls, as Jay Trader would say, to really pull the trigger on the trade and have that full level of conviction, and then not only take the trade but hold the trade down to where it needs to go. And if your conviction isn't there yet, or you slacked on your research, then your outcome isn't going to be as good, or you're going to make too many mistakes because you're jittery. So that's why I posted that tweet, because that's really the main thing is, can I convince myself? My wife sometimes has to be like, give me a rule, like you're not allowed talking to me about stocks when after this particular time at night, because I'm constantly convincing myself by talking about it. So yeah.
Okay, another question from Brian Lilly. Do you always close your option position intraday, or do you ever swing trade options? If you swing an option and now you're buying a call or a put, do you take into account time decay? Okay, I can answer very, very fast. Yes, I also swing options, but I have to have a conviction for this. I generally swing options, which are monthly, so not weekly expiration. And yeah, you basically go to see the theta, the time decay, but this depends always from uh, where you think the price will go. So if you think like I have some conviction will go 270 then 240 Netflix in the next months. So basically, I swing that, and we build a position into that. So let's go another one. Roy Fukahashi. Will you have a recap of this on video YouTube? Yes. Another one from Brian Lilly. Price movement of the underlying stock is not the only factor that affects the price movement of an option. Do you take into consideration other factors such as volatility? You want to
Yeah.
answer, Dell?
Yeah, definitely. And I sort of alluded to that when I was talking about a stock that moves more is going to have a wider range of strike prices that are more highly affected by the movements in the price. So yes, you have to take that into account. And trading. That's why you should really. The other thing is, make sure you're only trading stocks, large cap stocks that have a lot of options volume, or a lot of implied option volatility, because you don't want to be stuck in a position where the stock moves but there's no options to trade, right? So the answer is yes, we take it into account. The best, like Netflix, for example, has a lot of volatility, and therefore the options move a lot, and that means that we can make more money on it.
Okay, another question. Short trader, aren't price volume divergences way more important than the price RSI divergency? You want to answer, Del? Being that you use the RSI,
Yeah.
I can tell that you really come from the futures for that fact, bro. That you use
Yeah.
RSI.
The answer is no, it's not.
Okay.
It's just they're just different ways of looking at the market.
Jordan Ryan, and this is also for you. You became popular tonight. Intraday, would you say volume profile levels are stronger than intraday candle levels? This is also important, guys. Listeners, where I would like to know what Del thinks.
So uh, volume profile. So it's not a chicken before the egg situation when it comes to volume and candlesticks. Candlesticks are an indicator. Volume is a structural component of the market. So behind a candlestick is a distribution of volume. It doesn't matter what period. This could be a 1 minute, a 1 month, a 1 week, 1 year candlestick. But a candlestick only shows you the open, the close, the high, and the low. Whereas the volume inside of that level and the period of that level, like say it's a 1 minute, gives you an enormously larger amount of information. So volume is always, and volume profile is always more important than what the candlestick has done in any one particular period.
Okay. Um, Another one. This is for me. Can you explain mini trend using another stock like Apple? Okay, I would need to screen share this. We're a little bit out of time, but basically, I'm looking at Apple daily. And the first thing I see, I look for is where is that compared to the 7289 EMA. And then, according looking deeply, I go to check or a 5 or a 9 or a 13 EMA where the price is if above or below that EMA. So you can choose whatever these. You basically need to see like a mini trend. So like higher highs and higher lows or
Did you
lower
want to share
highs and
your
lower lows.
screen
Um,
or
I
no?
can put it here. Just 1 second because I had another screen on.
Sure.
Okay, let's see if this will work. Okay, so basically, I think you see my all screen over here.
Yep.
So this is Apple. Okay, you see basically this is a mini trend on Apple because it's basically starting to be below. In this case, I have a 5 EMA here, but it's starting to make lower highs, lower highs. So all these days over here, I will only look to short this. Okay, so that's the main point. Okay, let me see what else. Jordan Ryan, only thing about market orders with options, sometimes you don't a lot right away scary. Okay, I know what you mean. Yes, Jordan, if you enter at the open something like Netflix today, or even better, yesterday, yes, you have to be aware that using market orders will put you right away in the spread zone. So for the open, the best thing is always to have limit orders, trying to catch the bid always for both calls and put. But during the day, I like to trade market orders, especially if it's there like a very high volatility. Okay, so you don't need to fix the price and all this stuff and get out. Just market order. That's it. Um, do you guys focus from NN on directional option trades or more complicated straddles, iron condors, and all this stuff? I read all this stuff, bro, and I think it was like in the 2010 or something like this. It really fucked up my mind. Straddle actually is very simple, but no, I don't use all that into my trading. And you, Del?
I do, but it's in my long-term trading accounts. I'll trade what they call volatility short trading. So I'll be doing I'll be try and collect option volatility premium using like iron condors and or straddles or strangles, things like that. But that's really long-term stuff, um,
Okay.
not in day trading.
Travis Kirschner, let's say you only want to risk 100 bucks for an option trade, but options on your target strike are too expensive. Can you buy cheaper out of the money options, even though you know it's not likely to hit your strike, but then just sell the option back once you've made a profit? Okay, uh, this happens very often. So if I have to answer on this, and I know that my price target won't be hit, okay, because I'm playing maybe a weekly option, and in 2 days, Netflix has to go from 300 to 260, I will not buy a put 240 so much out of the money because I want to pay it cheap. I just will pay something like just out of the money or at the money or in the money. Okay, so the nearest strike prices, and I will just like trade intraday. So pay a little bit more, and that's it. I mean, if you want to buy an option because you want to trade option because each option you think is cost 100 bucks, no. If you have 100 bucks in your account, you cannot trade, not options, nothing, not even put in the roulette. At least you need like at least 2 3,000 bucks, and then you buy cheap options. John Pecknick, how do you predefine risk on options trade? For example, if you want to risk 100 bucks and be that your premium, how do you know which option to buy? Consider one contract as the minimum. If you want to risk 100 bucks and you want to buy one contract, means that um, what else? The contract you want to buy, it will be like the strike price, um, $1, right, Dell?
Yeah, exactly.
Short trader, Dell, what is the name of your charting platform? I think you already said it.
Yeah, it's
TradingView.
TradingView.
Okay.
I'd give you my
Anonymous.
affiliate link, but I
Sorry.
don't know how to do that. So
Okay. We can post it later. Or you can write Dell like an email or on Twitter, and he can like write you back. Anonymous attendee, can you please explain how you use volume profile on large cap trades? Wow, this
uh,
is already what we've said. I mean, like I think, at least for me, Dell, correct me if I'm wrong, is the same thing that you have on the small caps.
yep.
Another one, what are the blue dotted lines on the chart? Think is in your charts, Dell.
Oh, those were just price levels that I identified in the past. That's all. They're just
What
the
is the,
horizontal
okay?
rulers.
What is the difference between the two volume nodes on the bell curve, one on the left and one on the right?
So he's talking about this bell curve. So they're both low volume areas. That's all. So a bell curve is basically uh, maybe this price is $10 and this price is $100, but the price in the middle, at let's say I don't know 50 bucks or whatever, is the highest price, and then the two extremities of that distribution are the low value or low volume areas. That's all the difference between the bell curves edges.
Which is the granularity on volume profile? No, why is the granularity, sorry, on volume profile important?
Because if you don't have a granular volume profile, you can't spot the changes in volume as well as you would be able to from a more granular profile that gives you more detailed information. So
Yeah,
you wouldn't have all of the information. Right? It's like looking at it's like having a 640 by 480 screen versus a
yeah.
4K screen.
Dell, do you use MotiveWave for any EWT work for a macro view?
I'm trying to find where's. Sorry, can you
Around
repeat that question?
1002. Don't know what it means.
Oh, here it is. Do you use MotiveWave for any EWT work on a macro view? Oh, Elliott wave theory. Um, no, I don't use Elliott wave theory anymore. I'm not going to go through what Elliott wave theory is, but it's a basically It's a mashup of structure and Fibonacci retracements and extensions.
Yeah,
Um,
because then I will start talking about GAN and Chaos theory as well.
exactly. So no, I don't really use that anymore. I found this strategy to be far more efficient.
So Brian is on fire tonight. What came first, the chicken or the eggs? Do support resistance price levels generate the volume, or does the volume generate the support resistance price levels? I'm not into this philosophical stuff, Del. So if you want to answer, you can answer.
Definitely uh, the egg, I guess. So volume
Okay.
generates the support and resistance levels, 100%.
Aaron Stadnick, it is valid to draw support resistance based on the close of high volume days using the volume histogram of on the bottom of the chart.
No, volume, when you're drawing these levels, they're zones, they're not levels. Anybody that tells you that support and resistance is one price level is not doing it right. It's a
Exactly.
zone. It's a zone.
Exactly.
Yeah,
If you look at PTI example, I was looking the other day with some guys on the daily, and I take into consideration high volume days. So just want to show this because I think it's important.
sure.
Let me see, main screen. Okay, it's a big screen, so I hope you all see it. You see all these areas I have here, guys. So let's put it even bigger. I want to drive you crazy now. And this is me after 10 hours or more at monitors. So you see over here, basically this high volume day. So for me, the close and the high of this, all this area is the volume. You see basically these 1, 2, 3, 4 high volume days. So all this from the close to the high, all this is high volume area. And then I will go inside to look with a 5, 10 minute chart. Where are the high volume and low volume nodes as Dell explained. So when at the end you go to see on that big gap up day, flow rotation, and we all know what happened, you basically go to see all these lines, but it's not these lines itself, is what is inside. So it's all this, all this, all this, and so on. More. Can you explain AT123? Oh my God.
No, no, you'd have to sign up to my course.
Rob Melgarejo, I have seen that sometimes in the volume at dollars, you can split between red and green color bars. Is the color matters to you? Okay, I answer and then you can answer back. For me, no. I just need to see how the price close, if below the open or not, and that the only thing matters. Many of my charts have not the color. You know it from the close of the bars.
Yeah, I agree.
Can you explain NAK day to day using volume profile analysis? That's for you, Del.
Oh man, really, maybe really, really quickly.
Maybe another time.
Okay, maybe another time.
One issue I have is that the stock, if the stock is below VWAP, it considered bearish. But if a stock is a clear uptrend, clear creating higher lows, do I anticipate it's going to fill VWAP, or I'm long bias because it's an uptrend? Okay, I can answer very good because every day happens. So you have to keep into consideration what is the float of the stock, at what time you are on the day, if this stock is generally manipulating. You're referring to this like today on NBEV. And if you look at NBEV, what can do? Going up VWAP, then fall below VWAP, trap more, and then go more up and squeeze everybody and manipulate. Like if you put VWAP today in the morning, we were below around 9:45, like that. Then around 10:15, we reclaim. And once we reclaim, all the people they are stuck in the morning, they were like short strap, and then like started to go up and hold its dip. So basically, those are the main things you have to look. Okay, so the float, even the percent of short float, if a stock manipulated and trapped in the past, and Bev guys is like the A1 for this. Can you explain the Greeks? Uh, we already spoke about something. It will take only one webinar to explain that. What are the parameters you check for options liquidity? Only to go to see the volume traded for the option in that morning or the prior day. If you work with weekly options, okay, just go to see the strike you're interested and look today and the day before what were and are the volume traded. Uh, there's like a long one. And
Yeah,
then there is,
I'd also look for implied volatility. So
okay.
the IV on the day. You wanted that implied volatility to be high.
Another one, how to build that conviction you are talking about. So we are talking about conviction. Maybe you are talking about conviction.
Yeah.
Yeah.
Well, you have to use all of these methods that we're talking about together. You don't really have conviction until you've traded for a few years and you've really understood the markets. Then you'll find that real conviction. Short term, just try to understand everything as well as you can and form your own opinions.
Another one, it was uh, what to think about NVDA now, how you can trade options with it. You cannot, because after 4 o'clock, you can't. Another one, we have the last two over here. Do you find any value exploring the unpopular babes that might be low key super hot? For example, do you find those levels on the bell curve an area where you have a short or a long setup?
Yeah, so the areas, the volume areas, you shouldn't be thinking about whether they're long or short areas. You should just be thinking about the type of action that there's going to be at those areas, right? Remember, we're not trying to predict how price is going to move, only that there's going to be some kind of a decision made there. So that's why you use your advanced order flow analysis, BookMap, your level 2, your tape reading to really understand the battle between buyers and sellers at that particular price level.
Another one, Aaron Stadnick. Dell, do you use an indicator at all since you said you use a naked chart, or is it primarily based on price reaction to price zones?
I don't, the only indicators I'll use are VWAP, some basic moving averages, and RSI, and then my volume tools. So I guess it's really not that naked, but it's naked compared to a lot of people's charts.
Okay, I think we're done everything.
That's it, man. I want to thank everybody for joining us in the room. I think we had like a really killer 66 minutes and 30 seconds. We didn't really go off too much, and I think we stuck to our plan and we got through a lot. And I definitely want to do it again, Jay. So thanks for coming up with
Yeah,
the idea.
think in the next weeks, guys, there will be another webinar on another matter, always with me and Dell. Thank you very much, guys.
Yeah, and if you guys want to find us, make sure you check out. We both have live trading rooms. We both have education and stuff that we're doing every single day for our members. So for JTrader, head over to JTrader's Twitter. It's at JTraderCO, and you'll find details on how to join his trading room. And for me, you can find me on Twitter at DellTheTrader, and you can head over to activetraders.chat, where you can join our community, take the course, or just follow on Twitter and keep in touch.
Goodbye. Have a good day.
Goodbye, everyone.